Hello, welcome. 16th August. What a day it was. Very slow one. You can see on screen. We can see a trade that I've marked out. And overall, very slow market after the data that came out in the morning for GBP. We're going to talk through it all today briefly and discuss what to do going forward. So if we look on the calendar right now, we can clearly see inflation rate came out decreasing year on year. However, with core inflation, it actually is staying the same. It is very sticky. It hasn't moved. What does this mean for us? Well, for myself, people in the UK, it means that the Bank of England, sorry, are going to more than likely going to increase rates again, especially after our wages yesterday. Wages data came out very positive, still growing at a higher rate than we would have wanted or anticipated. This is because if wages are increasing, people are more likely going to keep spending, and this is a never-ending cycle where inflation is still staying high and not actually getting tamed the way that they want it. So the only way they can really do this through monetary policy is the interest rate hikes. So what we'll see is, and you can see from the most recent polls that have gone out now to economists, that the chance of another rate hike in September, I believe on the 21st, is increased, most likely going to be at 0.25% again, and then even another one all the way up to 6% by the end of the year, right? So not looking too good if we're in the UK in terms of inflation. It's very sticky. You remember there's a big delay as well with all of these data events, right? So the longer inflation is still high, the longer the delay is going to be into 2024, 2025. So unfortunately, rates are going to be held high for a very long time, minimum 12 months. And we won't even see proper declines back to, let's say, 3% interest rates till 2025. And that's something everyone in the UK is going to have to feel the brunt of, or feel the brunt of, especially in our economy in terms of unemployment rate. We saw that increase. That's going to keep increasing to 5, 6, 7% potentially on the worst end. But overall, we need to reel in the spending. And by we, I mean the UK economy as a collective, to reduce our inflation. And what we're looking at today, obviously, is this gave us more buys, because it's if inflation's high and we need to and the Bank of England need to raise the rates again, this is strong for the pound, right? Hence why we've broken highs again, creating even more all-time highs wrong word. We've created new highs for this year, and we're reaching levels that we haven't hit since 2015 again. So we are creating highs in the last 8 years, but not all-time highs. So as we can continue creating bullish market structure, what we saw actually today after that data came out was a lot of slowdown, lower volume, lower volatility in the markets. How do we know this? We know this because of the size of the candles. 7 pip, 15-minute candle. Extremely small, right? Even if we look at the 1 hour, look at these candles. Look at this candle here. A 17 pip candle, 18 pip candle. It's smaller sized candles, right? Yes, the moves are happening, but they're very slow. For example, you could have taken a trade at this key level of 185,500. If we hop to the 1 minute quickly, we can clearly see, look how slow this move was just to move 30 pips. Over an hour to move 30 pips. If we are, as retail traders from the past 2 years, used to a lot of higher volume and higher volatility times, and now we're actually entering a market where we're starting to see lower volume, lower volatility, and we need to adapt this accordingly. Maybe our risk rewards will need to be shorter. However, on the contrary to this, when there is lower volume of volatility and the moves do happen, as you can see, but just very slowly, your stop loss subsequently will be actually less. So instead of a 15 pip stop loss, it's more likely going to be 10, 8 on GJ, for example, because price is moving less and less. 1 minute candles are sometimes not even a pip long, sometimes 3 pips, right? So it's all varying, but just to take that into account, where we are in the market, what we're doing going forward, and how to manage our trades, really. So the whole trade idea I had, I didn't see any trades that I could have taken during London. Nothing for me. What I was happy to see is a break above here of the 185,300, which we created at a high yesterday. Then we got a consolidation, a double bottom form on the 15 at 185,500. And I was like, right, this could easily continue going up, which it did. I didn't fancy taking a buy at 2 o'clock candle when the 4 hours forming, right? And then once I saw, right, if we break above this area, we're more than likely at 3 o'clock going to have a bit of volume in the markets as usual. And I'm going to take an impulsive entry. Good time to enter. Happy with that. Let's hold down to the 1 minute to see our entries. And you can clearly see we got the impulsive entry once we started breaking above the highs. We got a pullback slightly. You could have got better entries here, but our stop loss was in a very safe place. And then we continued going up. I aimed for 186,200, very aggressive. Realistically, it was only ever going to go to 186 flat. Main reason is key psychological level is we're at all-time highs for this year. The chances of us continuing without pulling back, gathering more liquidity is very slim. So this was a very risky trade. I managed it quite aggressively. I closed pretty much break even, a slight loss. I could have left it and it would have hit 186. But in my opinion, it was a quick entry in and out. If it wasn't happening how I wanted it, I didn't want to be in the trade. So I'm happy the way I managed it. Overall, it lacked volume, right? And lacked volatility. In these markets, there's no real point in forcing a trade, right? So if we hop onto the calendar again, what's going on for tomorrow? Some Japanese data coming out. And overall, some more US data in the afternoon. Philadelphia Fed Manufacturing Index and initial jobless claims. These are the two to keep your eye on, especially if they are, one, synchronized, as in they're both telling the same story, and two, they're telling the same story as previous data releases from the US, indicating potential dollar strength again on the tables, with the XY hitting 103, as you can see, and breaking 103, 200, going to 300, and maybe even breaking up to 400, 500. What else can we see? Well, we can also see on the Friday, we've got inflation rate for the for the yen, the Japanese yen. So that will tell a story as well for GBPJPY. And again, we've got GBP retail sales. Once again, will tell us a story. How's the economy doing with all these high interest rate environments? And overall, that's going to close out the week pretty much. So those are the key ones to look out for going into tomorrow and the day after. We may even see low volume and volatility for the rest of the week. That's what we should plan for. Always come in with expectations level-headed and understand that the market can go this way or that way. Just trade what you see and make sure you follow your plan, because you will succeed that way. And then if we check the market screen here, you can see the trade that I took there, just pretty much break even.